What if the biggest AI trade is no longer the chip trade everyone is already watching? For the last 2 years, retail investors have been trained to look at Nvidia, AMD, and Broadcom as the center of the AI boom. And to be clear, those are still critical companies. But smart money may already be asking a different question. Not just who sells the chips, but who powers the chips? Because AI does not just need GPUs. AI needs electricity. AI needs substations. AI needs transformers. AI needs grid connections. AI needs reliable generation. And increasingly, AI needs nuclear power. That is where the second act of the AI trade may be hiding. Before we break down the 5 AI power infrastructure stocks that could matter most, subscribe to Stock Breakout, hit the like button, and drop the one power stock, nuclear stock, or grid infrastructure name you think Wall Street is still underestimating. The obvious trade is AI chips. The hidden trade may be AI power. And the key question for investors is simple. If AI data centers become one of the biggest new sources of electricity demand in America, which public companies could Wall Street reprice first? This is not just a theory anymore. The International Energy Agency said global electricity demand from data centers grew 17% in 2025, while electricity consumption from AI-focused data centers surged 50%. The IEA also expects total data center electricity consumption to roughly double from 2025 to 2030. The U.S. Department of Energy also pointed to EPRI estimates that data centers could grow from about 4% of U.S. electricity load in 2023 to as much as 9% of U.S. electricity generation annually by 2030. That means the AI bottleneck is moving from silicon to electrons. And when the bottleneck moves, capital usually follows. Think about how markets work. When everyone first sees the obvious winner, the trade becomes crowded. Then Wall Street starts hunting for the second-order beneficiaries. During the smartphone boom, investors did not only buy Apple. They looked at chips, glass, sensors, memory, radio frequency, and assembly. During the AI chip boom, investors did not only buy Nvidia. They looked at networking, memory, cooling, data centers, and power equipment. Now the next question is whether AI forces Wall Street to reprice the entire power stack. Generation, nuclear fuel, utilities, electrical equipment, transmission, engineering. That is the setup. Here is the 5-stock AI power infrastructure watch list. Constellation Energy, ticker CEG. Vistra, ticker VSD. Cameco, ticker CCJ. Eaton, ticker EEN. And Quanta Services, ticker PWR. These are not 5 identical trades. CEG is the clean nuclear power operator. VSD is the merchant power and nuclear PPA angle. CCJ is the uranium and nuclear fuel supply angle. Eaton is the electrical equipment and power management angle. PWR is the grid infrastructure and engineering angle. Together, they form the power side of the AI trade. Let's start with Constellation Energy, ticker CEG. This may be the cleanest AI needs nuclear power stock in the market. Constellation signed a 20-year power purchase agreement with Microsoft tied to the restart of 3 Mile Island Unit 1, now called the Crane Clean Energy Center. Microsoft is buying power from the renewed plant to help match the electricity its data centers use in PJM with carbon-free energy. That is important because it shows the market something very specific. Big tech is not just talking about clean power. Big tech is signing long-term nuclear deals, and that changes how investors may value existing nuclear assets. The bull case for CEG is simple. Existing nuclear plants are hard to replace. They are reliable. They run around the clock. And if hyperscalers want carbon-free power that is available every hour of every day, nuclear becomes strategically valuable. Constellation is not a speculative SMR company waiting for future reactors. It owns real nuclear assets today. That is why CEG may deserve a premium in an AI power shortage environment. But the risk is also clear. CEG has already been discovered by the market. Nuclear headlines can drive valuation higher, but regulatory approvals, project timing, power prices, political risk, and execution still matter. A great theme does not automatically mean a cheap stock. Next is Vistra, ticker VSD. Vistra is a more aggressive version of the same AI power theme. The company announced 20-year power purchase agreements with Meta to provide more than 2,600 megawatts of zero-carbon energy from 3 Vistra nuclear plants in PJM. The agreements include operating generation and additional nuclear uprates, which Vistra described as the largest nuclear uprate supported by a corporate customer in the United States. That is a major institutional signal. Meta is not waiting for a theoretical future power solution. It is locking in real nuclear capacity. And Vistra is one of the companies standing directly in front of that demand. The bull case for VSD is that AI data centers need reliable power fast. That makes existing power plants more valuable. Vistra has nuclear exposure, gas exposure, retail power exposure, and merchant power optionality. If power demand keeps rising faster than supply, Vistra could benefit from tighter electricity markets and long-term corporate demand. But the risk is that VSD can be more volatile. Merchant power economics can swing. Commodity exposure matters. Regulation matters. Weather matters. Valuation expectations can get aggressive. And after a huge move, investors have to ask whether the AI power premium is already priced in. So VSD may have major upside if the power shortage narrative keeps expanding, but it is not the lowest risk name on the list. Now let's talk about Cameco, ticker CCJ. Cameco is not a data center stock. It is not a utility. It is not an electrical equipment company. It is the upstream nuclear fuel angle. If AI demand pushes more utilities, governments, and hyperscalers toward nuclear power, uranium demand and nuclear fuel security become more important. Cameco has said nuclear fuel demand continues to increase, while future supply is not keeping pace. The company also said roughly 116 million pounds of uranium were placed under long-term contracts by utilities in 2025, with uncertainty around supply driving more contracting activity. That gives CCJ a very different role in this watch list. It is the fuel behind the nuclear fuel cycle. The bull case for CCJ is that the world may need more nuclear power than investors expected. If existing reactors run longer, if new reactors get approved, and if nuclear becomes a strategic energy source for AI infrastructure, then uranium security becomes more valuable. Cameco gives investors exposure to that upstream nuclear supply chain. But the risk is that CCJ is less directly connected to AI data centers than CG or VSD. It is more exposed to uranium pricing, contracting cycles, mine supply, geopolitics, and sentiment around nuclear expansion. The AI power theme can help the narrative, but CCJ still trades like a nuclear fuel and uranium name. That makes it powerful, but also more indirect. Next is Eaton, ticker ETN. This is the electrical equipment and power management angle. If AI data centers are going to consume more electricity, they need more than generation. They need switchgear. They need transformers. They need power distribution. They need backup systems. They need high-density electrical architecture. They need the equipment that makes electricity usable inside the data center. Eaton reported that its 12-month rolling average orders in Electrical Americas were up 16%, driven by data center momentum, and that its electrical sector backlog was up 29% year over year. That is why Eaton belongs in the AI power conversation. It is not selling the GPU. It is selling the power layer around the GPU. The bull case for ETN is quality. This is a real industrial company with scale, margins, backlog, and direct exposure to electrification and data center power demand. And because AI racks are becoming more power dense, the electrical infrastructure inside and around data centers becomes more important. The risk is valuation. High-quality industrial compounders rarely stay hidden forever. If investors already understand that Eaton benefits from AI data center power demand, then the stock may need strong execution to keep working. ETN is probably not the most explosive name on the list, but it may be one of the highest quality ways to play the AI power infrastructure build-out. Now the fifth stock, Quanta Services, ticker PWR. This may be the most important hidden winner in the group, because even if America builds more generation, that power still has to reach the load center. That means transmission, substations, interconnection, grid upgrades, electrical construction, engineering, and Quanta sits directly in that bottleneck. In its 2025 annual filing, Quanta said technology customers' data center build-out for cloud services and AI training and inference increases demand for its solutions. The company specifically pointed to low-voltage electrical infrastructure inside data centers, high-voltage substation and transmission interconnection infrastructure, and generation infrastructure needed to power those facilities. That is almost the entire AI power bottleneck in one business model. The bull case for PWR is that Quanta does not need to predict which power source wins. Nuclear wins? The grid still needs work. Natural gas wins? The grid still needs work. Solar and storage win? The grid still needs work. Data centers cluster around major load zones? The grid still needs work. Quanta is a picks and shovels company for the physical infrastructure behind AI electricity demand. And its investor relations page shows 2025 revenue of $28.5 billion, with utility and power representing an estimated 70% of 2025 revenue by customer type. That gives PWR broad exposure to the power infrastructure CapEx cycle. The risk is execution. Large projects can face delays, labor pressure, weather risk, permitting issues, and margin volatility. And after a strong run, valuation still matters. But strategically, PWR may be one of the most direct ways to invest in the grid bottleneck. Now let's compare all five. CEG has the cleanest nuclear power signal because of the Microsoft agreement. VSD has the most aggressive corporate nuclear PPA signal because of the Meta deal. CCJ has the upstream nuclear fuel angle. Eaton has the highest quality electrical equipment angle. PWR has the broadest grid infrastructure and engineering angle. So the key question is not just which company benefits from AI. The better question is which company benefits if AI power demand becomes a multi-year infrastructure cycle. That is how I would rank them. At number 5, I have Cameco, ticker CCJ. Not because the uranium thesis is weak. The nuclear fuel story is real. But CCJ is the most indirect AI power stock on this list. It benefits if nuclear demand expands, but it is not signing data center power agreements, building substations, or selling data center power equipment. It is a strong nuclear cycle name, but a more indirect AI infrastructure play. At number 4, I have Vistra, ticker VSD. The Meta deal is a major signal. Existing nuclear power is valuable. And merchant power exposure could be very powerful if electricity markets stay tight. But VSD also carries more volatility, more commodity sensitivity, and more valuation risk after the market already rewarded the story. At number 3, I have Constellation Energy, ticker CEG. CEG may be the cleanest nuclear AI power name. The Microsoft agreement is exactly the kind of institutional signal investors should pay attention to. If big tech continues to value reliable carbon-free power, Constellation's existing nuclear fleet becomes more strategically important. But CEG is no longer an undiscovered idea, and the market may already be pricing in a lot of nuclear optimism. At number 2, I have Eaton, ticker EEN. Eaton is not the most dramatic stock on the list, but it may be one of the best business quality plays. The AI data center build-out needs electrical equipment, power management, and high-density infrastructure. Eaton is already seeing data center momentum in orders and backlog, which makes Eaton a serious institutional quality AI power name. At number 1, I have Quanta Services, ticker PWR. Not because it is the flashiest stock, because it may be the broadest bottleneck stock. If AI needs more electricity, power has to be generated, connected, transmitted, distributed, and engineered. Quanta touches that entire physical build-out. It is not a pure nuclear bet. It is not a pure utility bet. It is not a pure equipment bet. It is the infrastructure contractor behind the infrastructure cycle. And if the second act of AI is power, PWR may be one of the first names investors should study. So here's the big takeaway. The AI trade may be entering a new phase. The first phase was chips. The second phase may be power. Nvidia, AMD, and Broadcom showed investors where the compute boom started. But AI cannot scale on chips alone. It needs electricity. It needs nuclear power. It needs utilities. It needs electrical equipment. It needs grid infrastructure. And it needs engineering companies that can actually build the physical network. The obvious trade was AI chips. The hidden winner may be AI power infrastructure. My final ranking is this. Number 5, CCJ. Number 4, VSD. Number 3, CEG. Number 2, EEN. And number 1, PWR. That does not mean every stock is a buy today. Valuation matters. Timing matters. Risk management matters. And nothing in this video is financial advice. But if smart money is already rotating toward the power side of AI, retail investors need to understand the map before the headlines become obvious. If you want more second-order market breakdowns like this, subscribe to Stock Breakout, hit the like button, and comment which stock you would rank number 1. CEG, VSD, CCJ, ETN, or PWR.